In this analysis, we're diving into a massive, honestly pretty counterintuitive financial mystery. Systematic investment plans, or SIPs, are basically hailed everywhere as the ultimate wealth creation tool for the everyday person. And honestly, the math behind them is practically flawless. Yet, despite this, almost everyone fails at them. It's crazy. Today, we're going to break down exactly why this happens in this explainer, and more importantly, how you can avoid the hidden traps that completely derail so many people. So let's just jump right in.
Look at this number, 100%. According to a pretty staggering recent article in the Economic Times, the mutual fund SIP stoppage ratio recently hit exactly 100% in the month of March. Just take a second to really process that. That literally means the total number of people stopping their investments completely canceled out the number of people starting them. No net growth at all.
The math behind that alarming headline is crystal clear. In March alone, 53.38 lakh people canceled or completed their SIPs. Meanwhile, the new registrations for that exact same month sat at only 52.82 lakhs. When you divide the closures by the new starts, bam, you get a stoppage ratio shooting right past 100%. The number of people just throwing in the towel on their investing journey has shockingly outpaced the people beginning it, which leaves us asking, why? Why are so many people fleeing?
Well, this builds into an even grimmer reality, the 5-year attrition funnel. The source data shows that if 100 people start an SIP today, 50 of them, literally half, will give up within the very first year. And if you zoom out over 5 years, a massive 97% of investors will have stopped their SIPs entirely. Only 3% persist long enough to actually see real compounding do its magic. So the absolutely crucial takeaway here is this. People aren't failing because the market is broken. They're failing because they simply cannot stick with the plan.
But hey, don't worry, because there is a concrete way to beat these odds. Transitioning from the mystery of why people fail to the mastery of how you can actually succeed, our source lays out an exact 5-step roadmap to avoid becoming part of that 97% failure statistic. The rules are: secure insurance, start small, survive volatility, step up your contributions, and pick out outperformers. Let's break these down one by one.
Moving right to Rule 1. The medical emergency trap.
You know, when we think about why people stop investing, we almost always blame things like market crashes or a sudden job loss. But look at this sheer devastating scale of a much more insidious threat. 7 out of 10 Indians are just one hospitalization away from bankruptcy. Right now, medical inflation is running at a massive 14%. The source data highlights a heartbreaking reality. Every single year, approximately 4 crore people, that's 40 million individuals, fall into poverty strictly because of sudden out-of-pocket medical expenses.
Let's look at how this plays out in real life with what we can call the Trojan horse lesson. Imagine you diligently invest 5,000 rupees every single month for 10 years. You do everything perfectly, and you build up a corpus of about 11 lakh rupees. It feels fantastic, right? But then a single major accident or a sudden illness in the family strikes. Because you're unprotected, the hospital bill completely wipes out that 11 lakh rupees overnight, reducing it to literally zero. Years of discipline just gone in a week.
So the fix for this is building an insurance shield. Before you even think about aggressive investing, you absolutely must protect your capital. The strategy here is pretty simple. Just increase your monthly financial budget by 1,000 rupees and direct it entirely toward comprehensive health insurance. The source neutrally highlights advisory platforms like Ditto, which provide IRDAI-certified expert guidance. That way, you can compare policies without the fear of annoying spam calls. They actually recommend utilizing top-up plans, meaning you can take a base 10 lakh rupee cover and turn it into a massive 1 crore rupee cover for a fraction of the cost. This essentially creates an impenetrable fortress around your wealth, ensuring your SIP stays untouched when an emergency hits.
All right, let's jump into Rules 2 and 3, starting small and surviving volatility.
Once your capital is protected, you actually have to protect your investments from your own psychology, specifically the trap of overcommitting your cash. The easiest solution? Invest a sustainable 10% of your income. Consistency matters so much more than starting large. The source points out a highly common mistake. Someone making 50,000 rupees a month might get super ambitious and start a massive 25,000 rupees SIP. But realistically, daily expenses always catch up. The budget gets impossibly tight, and they end up canceling the SIP entirely within just a few months. Instead, find your sustainable right amount, even if that's just 1,000 or 2,000 rupees a month. By committing to an amount you won't even miss, you guarantee the longevity needed to actually reach that 5-year and 10-year compounding mark.
Now notice the stark contrast in these one-year global market returns. In this specific data snapshot from the source, the Nifty 50 showed a negative 3% return over a one-year period. Naturally, people panicked. Meanwhile, Japan's Nikkei surged 66%, and South Korea's market absolutely exploded by 187%. The source explains this dynamic through something called country rotation. Foreign institutional investors, or FIIs, actively move their big money around the globe to wherever the market is undervalued. When India was booming earlier, South Korea was totally flat. Now the money simply rotated.
But hey, don't let that short-term flatline scare you out of your SIP. 13%. That is the historical 10-year average XIRR for the Nifty 50, which reliably bounces between 11 to 13% over the long haul. The absolute magic of an SIP is that when the market is down or flat, your automatic investment is quietly accumulating more and more units at a much cheaper price. When the FII money inevitably rotates back into the country, the people who stayed disciplined and kept investing during the dull phases are the ones who get massively rewarded.
Next up, Rule 4, the step-up strategy.
This right here is where we unlock the true mathematical superpower of compounding. As your career progresses, your salary obviously increases. But most people let their lifestyle inflate while their SIP stays completely flat. Notice the sheer difference a tiny tweak makes. Over a 25-year period, assuming a 13% return, a flat $5,000 monthly SIP will build a very respectable corpus of 1.13 crore rupees. Not bad. But if you simply step up your contribution by just 10% every single year, say going from $5,000 this year to $5,500 next year, your final corpus skyrockets to 2.45 crore rupees. That small, completely manageable annual step-up literally more than doubles your final wealth output. It's a game changer.
Finally, we have Rule 5, investing in market outperformers.
For those of you who have mastered consistency and really want to accelerate your wealth, data tools offer a massive edge. The source points to analytical platforms like Investing Pro, which use AI to filter the broader market down to the absolute fastest-moving momentum stocks. Check this out. In this 5-year backtest on a $10,000 investment, the standard Nifty 50 returned a solid 84.4%, growing the money to $18,000. However, an AI-curated Nifty 20 strategy, which dynamically rebalances your portfolio into the top 20 outperforming stocks on the first of every single month, would have grown that exact same $10,000 into $78,000. It's really about letting the data tell you what is actively moving rather than just guessing.
And this extreme potential difference is magnified even further when the same strategy is applied to highly volatile sectors like small caps. Neutrally looking at the source's data over the exact same 5-year period, the broader Nifty Small Cap Index returned 182%, turning 10,000 rupees into 28,000 rupees. But the AI-filtered Small Cap 20 strategy yielded a jaw-dropping 2,100% return, turning that same amount into 2.2 lakh rupees. The core logic here is pretty straightforward. In any market cycle, not all stocks move equally. Identifying and ruthlessly riding the specific sector outperformers can drastically alter your financial trajectory.
So, let's tie this all together into the Wealth Mastery Blueprint. This is your definitive checklist to ensure you don't become just another statistic. Number 1. Never invest a single dime without securing comprehensive health insurance first to protect your hard-earned capital. 2. Start your SIP with a practical, sustainable amount that won't strain your daily life. 3. Stay calm and don't panic when global money rotates and the market flatlines. Just keep accumulating units. 4. Commit to increasing your SIP by 10% annually to harness the true mathematical power of compounding. And finally, when you're ready, consider using data tools to ride the market's outperforming stocks. Executing these disciplined steps is exactly how you survive that 97% failure rate.
Which brings us to our final thought for this explainer. Why do you think starting an SIP is absolutely essential for your future? The math is incredibly clear. The rules of the game are laid out right here, and the major pitfalls have been identified. But the actual why, the deep motivation you need to stay the course for 10 or 20 years, has to come from you. Take a moment to really reflect on your own financial journey and what wealth actually means for your family's ultimate security and freedom. Thank you so much for joining me today. Keep learning, and I'll see you in the next explainer.